A project can report a 20% rate of return, a positive net present value, a 5-year payback period, and an apparently attractive accounting return, and still be the wrong investment. That is the central lesson of profitability analysis. No single percentage, ratio, or recovery period can represent the complete economic behavior of an engineering venture. You are not evaluating a static asset. You are evaluating a sequence of capital expenditures, operating costs, taxes, revenues, working capital movements, expansions, shutdowns, and terminal recoveries occurring at different points in time. The real subject is cash flow over time. When you evaluate a processing plant, pipeline, mine, utility system, manufacturing line, automation upgrade, or infrastructure project, your technical solution may be sound. The equipment may meet capacity, reliability, safety, and performance requirements. But engineering feasibility does not automatically create economic viability. You must answer 5 questions. How much cash must be committed? When must it be committed? When will the venture begin generating cash? How much economic value will it create? What risks could destroy that value? The most credible evaluation begins with a year-by-year cash flow model. That model should capture fixed capital, land, working capital, pre-production expenditure, research and development expenditure, startup costs, operating costs, general and administrative expenses, selling expenses, taxation, depreciation, revenues, later capital additions, and final salvage value. Do not compress these elements into a single investment number too early. Their timing matters. 1 million spent today is not economically equivalent to 1 million spent 6 years from now. Similarly, 1 million received next year is more valuable than 1 million received 10 years later. This is the time value of money, and any method that ignores it can create a misleading picture. The 2 principal discounted cash flow methods are net present value and interest rate of return, commonly called internal rate of return. Net present value converts each annual cash flow into its equivalent value at a selected reference point called time zero. Each cash flow is discounted using an approved discount rate, and the discounted values are added across the complete venture life. In conceptual form, net present value equals the sum of each annual cash flow divided by 1 plus the discount rate raised to the relevant time period. Annual cash flow is not accounting profit. It is the difference between actual cash inflows and actual cash outflows for the year. Cash inflows normally include sales revenue, service revenue, royalties, reimbursements, and terminal salvage value. Cash outflows include capital expenditures, operating expenses, working capital additions, startup expenditure, taxes, and other cash commitments. Depreciation is deducted while calculating taxable income because it influences taxation, but it is added back while calculating cash flow because depreciation itself is not a cash payment. This distinction is fundamental. Profit measures accounting performance. Cash flow measures the movement of money. Investors ultimately depend on cash flow. Suppose a 10-year venture produces irregular annual cash flows. Large investments occur during the initial construction period. Production begins later. Additional capital is required during the operating life. Revenues grow as capacity and market penetration improve. Working capital increases. At the end of the venture, land, equipment, and working capital are partly recovered. At a discount rate of 15%, such a project may produce a net present value of positive $25.5 million. That result means the project is expected to recover its investment, meet the 15% economic requirement, and create an additional $25.5 million of value at the selected time reference. A positive net present value supports acceptance when the assumptions are valid. A negative net present value indicates that the project fails to meet the required economic return. But the discount rate is not a decorative input. It may represent the company's cost of capital, minimum acceptable rate of return, opportunity cost, or another approved investment threshold. Change the discount rate and you change the result. A project can appear attractive at 10% and unattractive at 15%. If risk, financing conditions, or corporate return expectations change, the economic decision can also change. Net present value has several major strengths. It directly reflects the time value of money. It can accommodate different discount rates during different periods. It allows the values of project components to be added when the same discounting basis is used. It avoids multiple or false mathematical solutions. It is particularly useful when comparing mutually exclusive alternatives because it measures the absolute value created by each option. However, net present value also has limitations. It is expressed as an absolute monetary value, not as a percentage. A large project may show a high net present value while producing only a modest return relative to the capital employed. A smaller project may produce a lower net present value, but use capital far more efficiently. Net present value also depends on the selected discount rate. Two companies applying different economic thresholds can reach different conclusions about the same project. This is why net present value must be interpreted with capital scale, risk, strategic importance, and financing constraints. Now consider the interest rate of return. The interest rate of return is the discount rate at which the net present value becomes zero. It identifies the effective economic return generated by the project's forecast cash flow pattern. If the interest rate of return is 20%, the project's discounted inflows and outflows balance when discounted at 20%. This percentage format is attractive because it allows projects of different sizes and technologies to be compared on a common scale. A pipeline expansion, compressor upgrade, and new processing unit can all be expressed using a rate of return. But this apparent simplicity can become dangerous. The interest rate of return can produce multiple or false solutions when the cash flow sequence changes signs more than once. This can happen when an operating project later requires major reinvestment, environmental remediation, decommissioning expenditure, or a large midlife expansion. A conventional cash flow pattern normally begins with negative investment and is followed by positive operating returns. When negative cash flow appears again after positive cash flows have started, the mathematical equation may generate more than one rate. Which rate is economically meaningful? Sometimes none of them provides a reliable decision basis. The interest rate of return also assumes, implicitly, that interim cash generation can be reinvested at the same rate of return. That assumption may be unrealistic for exceptionally profitable projects. The rate is not additive. You cannot calculate the return of two project sections separately, add the percentages, and claim that the total represents the combined venture. When comparing mutually exclusive alternatives, do not simply select the alternative with the highest individual rate. Use incremental analysis. Calculate the additional investment required for the larger alternative and evaluate the return generated by that incremental cash flow. A smaller project may report a higher percentage return, while a larger alternative creates substantially greater total value. The correct decision depends on the return earned by the additional capital and on the organization's capital constraints. The important principle is clear. Net present value and interest rate of return serve different purposes. Net present value measures value creation. Interest rate of return measures percentage efficiency. Strong investment decisions normally examine both. You may also encounter return on original investment. Return on original investment is generally calculated by dividing representative annual net profit after tax by the original total investment. Original investment may include depreciable capital, land, working capital, and other non-depreciable investment expenditures committed during the initial investment period. The annual profit may be an average over several operating years, or the profit from a selected mature year. Using a mature year makes the calculation easy, but it introduces judgment. Early production years may include startup losses, low capacity utilization, and market development constraints. Later years may represent normal operation. Selecting only a mature year can make the investment look stronger than its complete life cycle performance. In the illustrative venture, return on original investment is approximately 20.7%, close to the 20% interest rate of return. Do not assume these values will always be similar. Their numerical closeness in one project does not make the methods economically equivalent. Return on original investment does not properly account for the timing of cash flows. It is based on profit rather than discounted cash flow. It may also become ambiguous when later capital additions expand the facility or when the project contains several investment phases. Return on average investment uses average annual net income divided by the average outstanding investment or average book value. Because asset book value normally declines through depreciation, the denominator may become significantly lower than the original investment. The resulting percentage can therefore be much higher. In the same illustrative case, return on average investment reaches approximately 39.9%, almost twice the return on original investment. Has the underlying project suddenly become twice as profitable? No, the calculation basis has changed. This is why every profitability figure must be accompanied by a definition. A percentage without its numerator, denominator, averaging period, tax treatment, and capital boundary is not decision-grade information. Return on average investment becomes particularly difficult when the venture includes multiple capital outlays, different depreciation lives, capacity expansions, or an earning life shorter than the depreciable life. Averaging can conceal the real pattern of exposure. It can turn a complex cash flow sequence into a clean percentage that looks precise but is economically incomplete. The payoff period, also called the payback period, measures the interval between the start of sales and the point at which cumulative undiscounted cash flow becomes positive. If the cumulative cash flow remains negative after 5 full earning years and becomes positive during the 6th, interpolation can estimate the fraction of the 6th year required. For example, when the cumulative deficit before the final recovery year is $10.5 million and the following year generates $83.7 million of cash, the interpolated fraction is approximately 0.13 years. The resulting payoff period is about 5.13 years. Payback is easy to understand and useful as a liquidity or exposure indicator. A project recovering its capital quickly may be less vulnerable to long-term market uncertainty, technology obsolescence, or political change. But payback is not a complete profitability measure. It ignores the time value of money unless a discounted payback variation is used. It ignores cash flows occurring after the recovery point. 2 projects can have the same payback period and completely different life cycle values. One may generate strong cash flow for 20 years after payback. Another may decline immediately after recovering its investment. Conventional payback can treat them as equivalent, even though their economic outcomes are radically different. Therefore, use payoff period as a supplementary risk indicator, not as the primary investment decision method. The most revealing way to understand a project is to plot its cash flow pattern. A strong cash flow chart should show annual cash flow, annual discounted cash flow, cumulative cash flow, and cumulative discounted cash flow. Annual cash flow reveals when major investments and operating returns occur. Discounted annual cash flow shows the economic weight of each year after accounting for time. Cumulative cash flow identifies conventional payback. Cumulative discounted cash flow shows when the project recovers its capital after recognizing the required return. The chart can expose what a single headline metric hides: prolonged negative exposure, delayed revenue, midlife reinvestment, dependence on terminal salvage, or vulnerability to one exceptional operating year. Be precise about time zero. It does not always coincide with the conceptual beginning of the venture. Early research, feasibility studies, or pre-production activities may occur before the main investment decision. Discounting may be referenced to financial approval, the beginning of major capital outlay, or another defined date. A 1-year timing error can materially distort present value, particularly when capital expenditure is large. Every economic model should clearly state the reference date, year-end or mid-year cash flow convention, construction schedule, production start date, and discounting basis. Inflation and escalation also require disciplined treatment. Capital costs, operating costs, wages, and selling prices may escalate at different rates. A model that escalates revenue but holds costs constant will overstate profitability. A model that uses nominal cash flows with a real discount rate or real cash flows with a nominal discount rate creates an inconsistent result. The economic basis must be internally aligned. Taxes must be connected to taxable income. Depreciation must follow the applicable asset lives and tax treatment. Working capital must increase as operations grow and must be recovered only when recovery is realistic. Land and non-depreciable expenditure must be separated from depreciable capital. Startup and pre-production expenditure must be placed in the correct periods. Salvage value should include only recoverable amounts supported by a credible disposal or recovery assumption. Do not use terminal value to rescue a weak project. If most of the net present value comes from an uncertain final year recovery, the project is economically fragile. For a decision-grade analysis, build the evaluation in layers. First, establish the technical basis: capacity, production profile, availability, efficiency, operating life, and expansion requirements. Second, establish the investment basis: fixed capital, owner's costs, land, working capital, startup, pre-production costs, and later capital additions. Third, establish the operating basis: production volume, selling price, operating cost, maintenance cost, staffing, utilities, and overhead allocation. Fourth, calculate taxes, depreciation, and annual cash flow. Fifth, determine net present value, interest rate of return, return on original investment, return on average investment, and payoff period using clearly defined formulas. Sixth, plot the annual and cumulative cash flows. Finally, test the assumptions: reduce sales price, increase capital cost, delay startup, lower production, increase operating cost, add a major maintenance shutdown, reduce salvage value, change the discount rate. You are not searching for a single attractive answer. You are testing whether the project remains economically defensible when reality moves against the base case. The strongest investment proposal is not the one with the most impressive percentage. It is the one whose cash flow logic is transparent, whose assumptions can be challenged, and whose economic conclusion remains credible across realistic scenarios. Use net present value to understand value creation. Use interest rate of return to understand percentage return. Use incremental analysis for mutually exclusive alternatives. Use return on investment measures cautiously and define their basis. Use payoff period to understand recovery exposure, not total profitability. And always inspect the cash flow chart. Because when the metrics disagree, the timing and structure of cash flow will usually tell you why. That is the discipline of engineering economics, converting technical choices into transparent investment consequences. When you master that connection, you stop presenting projects that merely work. You begin presenting projects that can be funded, defended, implemented, and sustained. Like, share and subscribe for more practical learning on engineering design, project economics, cost evaluation, and investment decision-making.